You're listening to the Big Cast, your source for the latest in financial technology. Brought to you weekly by the Best Innovation Group, with your hosts, John Best and Glenn Sarvati.
Welcome to another edition of the Big Cast. My name is Glenn Sarvati on behalf of the Best Innovation Group, where we like to do cool things with financial technology. And today we have an interview with Mary Grace Roski, who is the head of marketing at CD Valet, a company I've seen a couple of times on stage at Finovate. And they've got some interesting new data that they've released around the dynamics of the rate environment and the way that CDs tend to be priced in the retail market. And I think that's a pretty timely topic given what's going on right now in the world around Federal Open Market Committee, et cetera. So we'll be getting to that in just a second. Want to remind you, you can always find out more about the Best Innovation Group by checking out our website, big-fintech.com, or checking us out on LinkedIn at Big Fintech. Another place you can check us out, you can actually click through to this at the main website, but you can go directly to bigmerger.ai. For some really cool stuff that the team is doing right now. I have not been hands-on on this one, but I think it is really pretty impressive. When you look at the stories around the greatest opportunities for AI, one of them has to do with coding and basic kind of conversion, the fundamental stuff of some computer programming. We also know that data integrations and core conversions and things like bringing two institutions together can be pretty complicated. And when you're talking about a big project like that, it has a habit of sending all the other kind of strategic initiatives back because you got to redirect all of these resources. Well, there's an awful lot of merger activity going on right now in the space, and the Best Innovation Group has figured out a way through AI and learning by doing to help kind of harness those tools to make that happen more effectively and rapidly and efficiently. You can read about it at the website. We had an entire one that was completed within about 5 months, which is kind of unheard of as far as I can tell. It's just going to keep getting better because, as you know, AI learns the more things are done with it. And now that we have the experience, I think that can only get more and more efficient. So bigmerger.ai, take a look if you're interested. I think it's worth your time. A couple of things that happened out in the world this week. As I'm sure you saw, the Genius Act that governs stablecoin passed Congress. So that is now a done deal. It has passed the Senate. It has passed the House. And it's the law of the land. It'll take a little bit of time before the licensing provisions that create a level of stability, for lack of a better word, around stablecoins will totally take effect. One of the things I've read that I find very interesting is a side benefit of it is it very well may create a new demand for treasury bonds. We've already seen with a lot of other things going on that the demand for U.S. treasuries may be waning a bit, particularly given some of the turmoil going on with some of our overseas trading partners. Well, this very possibly because every dollar of stablecoin has to be backed by currency, whether it's actual deposits on record someplace at a depository institution, or whether it is treasury bonds. This could be a new source of demand, which of course would actually push the price down from a rate environment, which is great news overall for the economy. A couple of other laws. The Clarity Act also passed the House. This one is a pretty straightforward one, not dealing with stablecoins, but with crypto and other altcoins more broadly. And the main key to it is that it finally creates that clarity again. What a clever name. That actually says that, yes, these are going to be regulated as a commodity as opposed to a security. This one sailed through, I think, the most easily of all of them and is expected to have a similar easy sail in the Senate. So don't expect any more turmoil on that one. I think that'll be straightforward. And then, of course, because nothing can ever be easy, we've got the third one that also passed the House and I think has the less likely scenario of where it's going from here. And you can kind of tell where the mentality is behind it right from the name. The Anti-CBDC Surveillance Act. This basically says it prohibits the U.S. from pursuing a CBDC, even though the Fed has said they are not going to pursue a CBDC, and they wouldn't without an act of Congress. So it doesn't, from that standpoint, make a whole lot of sense. Here's the part that gets even more interesting, and I will post a link to a story I read about this one. It has been reworded as part of some of the horse trading that took place to actually get it passed. It now only is prohibiting the rollout of retail CBDCs, consumer facing ones, which I think is what most people are thinking about. Wholesale CBDCs are permitted. And according to this, there was lots of concern that the US could really fall behind in the financial services markets if you didn't have the opportunity from a tokenized deposits, tokenized reserves, ability for non-retail consumer facing tokens to work between business environments. So that piece is no longer exempted. The other one I was watching this week, over the course of the last a little more than a week, we've now got Q2 results, the volumes that have been posted from the FedNow service and RTP from the clearinghouse, the two real-time payment networks in the US, as well as the not quite real-time same-day ACH. So we now have their results through Q2, the first half of 2025. I've written a blog about this. We'll post a link to it if you're at all interested in the topic. I think there's a lot of weird little nuances in it that are worth kind of checking out that I'm not going to get into the details of here. So check that out. But the short version, the momentum continues. We, in our bingo game of our predictions for 2025, had one of the stakes in the ground was that FedNow volume would triple over the course of 2025 compared to 24. Well, we were way too conservative on that one. It will probably have tripled already by the time we get to the end of the month of August. And it now looks like it's probably going to grow. It's almost a slam dunk. It's going to grow 5x, and it's got a shot at growing 6x over last year. Now, again, that's off a much, much smaller base than RTP, which continues to be responsible for about 98% of all real-time payments. And then on top of that, again, you've got the same-day ACH, which is about triple the size of RTP. You put all three of them together, though, and they're still about a fifth the size of the number of paper checks that are written in the US. And if I'm to believe the headlines, paper checks are dead, which I don't believe, but just to give you a perspective on this kind of a thing. Even though the maximum is lower for the Fed, the average transaction is about 25 times larger. It's like 110,000. So they're clearly being used for very different reasons. Take a look at the link. I think it's worth your while, and I'll leave it at that. Happy to answer any questions if anybody wants to drop me an email after the fact. As I said, the other thing coming up next week at the end of July, depending on when you're listening to this, it's the end next week for me, the Fed Open Market Committee is meeting again. The consensus is that they are again unlikely to lower interest rates, despite a lot of jawboning they've been getting on that topic. They have not lowered interest rates yet in 2025, contrary to what a lot of people were expecting. And one of the things that, obviously that drives loan rates, mortgage rates, and things like that. It also is deposit rates that it affects. But I saw some really cool information that CD Valet put out about the fact that credit unions do very well, surprise, surprise, in the rates that they offer to their members. But also that despite the fact that overall interest rates in the market haven't changed for the first 6 months of the year, there's still movement in both directions, both up and down at the individual institution level that goes on a regular basis. So with the FOMC's action or inaction kind of in mind, I thought it was a good chance to check in with Mary Grace Roski and see what they've got to say about that. I'm here with Mary Grace Roski, the head of marketing and communications for CD Valet. Mary Grace, I first saw CD Valet, I believe it was almost exactly 2 years ago at Finovate Fall in September of 2023. Did an interview with some of your colleagues then because I thought it was a really interesting model. Looks like you've really advanced things quite a bit since then. And I saw some of the data you've been putting out recently. I think it's a consumer-facing site, to be clear to people. And you're moving more data out on a monthly basis that is free and tailored to consumers for the most part.
Right.
So thanks for joining me to have a bit of a conversation that I think nicely times with the Fed Open Market Committee.
Great to be here. Happy to talk about CD Valet. We are an online marketplace that connects consumers to financial institutions so that they can compare and open CDs. We've got a lot of great data on consumer behavior, a lot of great data on CD rates and trends. So there's value in that data for anybody who's in the CD market, whether you're a saver or a financial institution.
So, I mean, the idea is you're designing the site as a go-to source for this information for the consumers, but you've also obviously it's a two-sided market, so you're helping generate leads and provide information and insights to the financial institutions as well.
Yeah, financial institutions will probably tell you that gathering deposits is the biggest challenge in the industry right now. And CD Valet really exists to help them solve that problem by serving as a marketplace that provides visibility for great rates, visibility for great institutions, and a way to really level the playing field with the largest financial institutions who tend to dominate the marketing space, the advertising space for CDs digitally.
So how would you like compared to like a bank rate or a nerd wallet or somebody like that? I mean, and some of those are a little bit more card focused, but how would you compare contrast your value proposition from a consumer standpoint?
Our value proposition from a consumer standpoint is that we showcase the rates from smaller institutions. If one goes onto Google and types in best CD rates, you will be taken to some of those bigger brand, well-known sites, the bank rates, the nerd wallets, etc. And what you'll find there are the rates from the largest financial institutions and those that may have the largest advertising budgets, but you won't find the best rates.
Makes sense.
And CD Valet's mission is really to provide a platform where credit unions, community banks, regional banks that truly do offer savers the best rates have a platform where they can be showcased. And that's an easy place for savers to find them. So the mission really comes down to serving the savers by giving them access to the best rates so they can get the best returns on their savings and give financial institutions an opportunity to level the playing field when they really do have the best rates, but perhaps not the largest budgets.
Tell me if I'm thinking about this correctly. So I guess what you're giving is more impartial and comprehensive data. Your revenue model, I understand it is, I know that you've got the opportunity for the institutions to partner with you and do a direct click through for enrollment, as opposed to, okay, they can see it there and they can go out and find it themselves. But that's where your revenue opportunity comes from, as opposed to preferred placement. Am I thinking about that right?
Correct. We have 4,000 financial institutions with CD rates on CD Valet. Not all of those financial institutions are actionable, i.e., they don't have a little open now button next to them. Once a financial institution partners with us, they become a featured CD. They get an open now button next to them. That then is what generates the revenue model. So consumers can use the site to shop, and they will see 4,000 financial institutions and 30,000 rates. And then there's a select number of those that are under our featured column, which are the ones that tend to get more traffic and a higher level of visibility. But we felt it was really important to show consumers all the rates. And so they can find the options. Those options might be at a small credit union down the street, but maybe they don't know that credit union and they haven't ever seen their rates. You go to CD Valet and you can see those rates. So shopping is an important part of the CD experience for what we call the savvy saver, who is uh, those are the people who really are the target of CD Valet. They tend to be pre-retirement or retirement around the age of 60 or older. They are DIY wealth managers and they like to have more conservative federally insured investments. So they like CDs and they like to shop for rates. In some ways, they look for CD rates the same way other people look for, great stock tips.
Yeah. Or 2-for-1 deals at the grocery store or something.
Exactly.
So
And
that makes a ton of sense. And that makes sense to me. I'm curious, 4,000 FIs, is there a specific kind of screening criteria, or are the
there
other
is
5,000 that just don't offer CDs?
So there's a lot of variables that go into that. The first one is, do they have publicly available rates? Lots of financial institutions don't share their rates online.
Good
We have a
point.
team of rate watchers. These are real human beings who every day go look at all of these sites to gather the rates. And if they aren't publicly available, then we can't include them. We created a benchmark of 250 million in assets as kind of being where we start. If a financial institution is found to be, have super competitive rates and be under that, we're happy to include them.
Interesting. That's helpful. So let's get to the thing that I kind of was the reason that I thought would be the most interesting to talk to you at this specific time. Federal Open Market Committee meeting at the end of July. The data that you're finding, CD rates have been trending downwards somewhat. But what is interesting to me, and maybe it shouldn't be that surprising, not everybody moves in lockstep. So at the same time that the average is moving down, you're finding some rates going up at some institutions, going down at others. Can you kind of share a bit about what you saw, I guess, for June, for example?
Sure, it's fascinating when you do have 30,000 CD rates to look at, the ability to look at that and observe trends both by type of financial institution, credit union versus bank, and look at how they compare to historical activity, et cetera. And when we looked at our data from June, we found that about 42% of the CD rate changes were an increase. And that was despite the fact that the Fed Open Market Committee didn't change rates.
That's what's
Uh,
interesting. They haven't changed rates all year.
right.
CD rates are still changing.
And what's one interesting thing we've noticed that it's almost likely to see greater rate activity in anticipation of a rate change or a Fed Open Market Committee meeting than we do afterwards. So there's an anticipatory
Buy
change.
on the rumors, sell on the news.
Right. So that's definitely something that we see. And the data that we had from June did show that we had more credit union rate changes, and that the union rate changes were higher than the average bank CD changes. Credit unions continue to offer, by and large, the highest CD rates out there in the market. If we were looking at data at the end of June, we saw, looking at 12-month CD rates, 24 of the top 25 12-month CD rates on CD Valley were from credit unions.
That's amazing.
And I think it's important, it can be challenging for credit unions to find new members and to raise deposits. Many of them are small, they have geographic restrictions, employment restrictions, et cetera. And CD Valet is a platform that allows for marketing to those geo-restricted groups. We have a lead generation form process to fill out, basically to ensure that consumers who are looking for rates won't be sent to a credit union unless they're
So you
qualified.
have a field of membership filter, basically.
We have a field of membership filter that asks people, do you live in these counties? Do you work at any of these companies? So again, trying to support efficient marketing. We just can't put your rate up there and have folks look at it when 99% of them might not be qualified to join.
Interesting. And I think I remember seeing also not just 24 out of 25 being credit unions at the top. I think in aggregate, what was it, 16, 17% better rates on average, I think. Is that the number I'm remembering?
The average credit union CD rate APY was approximately 17% higher than the average bank CD rate APY
That's
as
for
of our June
that's
data.
for a 1 year rate. Is that's kind of your benchmark, or do
I
you
believe so.
you've got
Yes.
you keep track for all the different ones? So I mean, I think anybody who's close to the industry probably understands this. I know you've been a banker for a long time. Why would different institutions, credit unions or banks, why would maybe even in the same town, why would one be going up and one be going down at the same time? Just demand and need for deposits?
We see it's really based on, do I need deposits? Deposits are the lifeblood of any financial institution. And if they're in need of deposits in order to maintain their lending activity, meet their growth plans, then they're going to have to price accordingly to attract them. That's really what we see when we look at the financial institutions who come and go off the CD Valet, which is one of the benefits of digital marketplaces, kind of the ability to turn it on and turn it off. We need funds today. We're going to be on CD Valet. We're going to perhaps offer a more attractive rate than we usually do. When we meet our funding, we're going to turn it off.
Oh, interesting. Okay, so you literally are that real time in terms of the way, and
Totally.
they self-service on their end, or give you a call to turn it
They
off?
give us a call and then we make the adjustment. And it's not only for based on their funding needs, we want to raise X number of dollars, so we're going to jump on or off the site. But it's also, I only want to spend X number of dollars in the month of June on my digital marketing. So
Aha. So if
they
you bring
reach
in
that,
enough, they see the meter going. Gotcha.
then we can turn it off, which does make CD Valet a bit different than some other digital marketplaces, which have monthly minimums. And again, those monthly minimums are set to accommodate the largest financial institutions, not necessarily community banks and credit unions.
Now, you mentioned before that you kind of ballpark figure 250 million is kind of your baseline, but it sounds like you do, and given that there's a good number of credit unions in particular,
Oh,
community
yeah.
banks too, below 250, For the ones that are below that you still list, do they get in touch with you and say, hey, please pay attention to this too? Or is your team also just kind of looking for eye-popping rates that are below that threshold?
We have a financial institution, sales and success team that goes out and works with the credit unions or commercial banks who are interested in being on the site. I think one of the big benefits of being a financial institution partner on CD Valet is that you do get that partner from someone here who says, okay, let's talk about how much do you want to raise? What maturity makes sense for you? Let's look at the rate table right now. Let's look at who is on CD Valet right now and where are the opportunities. For example, we see a lot of competitive activity at the 6 month and 9 month, but no one's in at 7 and 8. This might be an opportunity for you to step in if that matches your financial strategy. So we really try to work with the financial institutions to help them be successful once they're on the site. And another part of that marketing that we do is email marketing to our subscribers. We have about 60,000 subscribers. 3 times a week, they get emails from us with opportunities with our best CD rates on there and information about CDs and how to use them. Um, it's really from a marketing perspective of credit union, one thing that we take on that responsibility of bringing savvy savers to your offer. And that's many people are often get frustrated with digital marketing and they say, I don't feel like it's working. I'm not sure that anybody's seeing my rates. Our job at CD Valet is to get your rates in front of the savvy shoppers.
I was going to say, I'm remembering something else I saw on the site, or maybe it was just in your report. The percentage of institutions that actually you're able to do an online CD account opening online is surprisingly low, at least to my perspective.
Yes, it is surprisingly low. I want to say certainly under 50%
That's
of
what I
financial.
remembered, kind of like
Yeah.
40-ish. So yeah, but
Yeah,
which that you can,
right.
and I guess that's one of the benefits, because if they enroll with you, you actually provide that service. You basically are providing a turnkey ability for online enrollment. Is that right?
Right. So we have CD Valet offers advertising, analytics, and account opening and many financial institutions don't have account opening for CDs. So we offer that as an option. There is obviously a tech lift with that, which can be, intimidating and perhaps more time consuming than financial institutions may want to take. But we'll see with our data and our experience working with CDs, if a financial institution offers digital account opening, a consumer might be willing to take a few basis points less for the convenience of being to execute the
Sure.
transaction real time. It's an important consideration if a financial institution is looking at how do I get more deposits, we need to make it as easy as possible for the consumer.
Makes sense. Now, it sounds like from what I'm hearing, we're probably, again, not going to see a change in rates with this open market committee meeting. But, the talk on the street from what I've heard is maybe in September. Certainly the expectation is 1 or 2 by the end of the year. I think you kind of addressed this already, but if and when that happens, what do you expect to see? Do you think that the rates will go down equivalently, or do you think it'll be a slower curve, or do you think they will happen before that?
I think it depends a lot on the individual institution and their need for deposits.
Yeah.
I think that becomes a big variable in this whole process. As I mentioned earlier, we do often see rate changes in anticipation of the Fed's activity. The lower end of the market, or of the maturities, 3 months to 12 months continue to be the highest rates right now. It's difficult to find competitive rates on the longer end of the yield curve. While the yield curve itself has flattened for CDs, it's still the same.
Interesting.
So shoppers who are looking for short-term CDs are continuing to get the best rates, while those on the long end are not seeing something so attractive. So if the impact of a rate change results in a more traditional yield curve for consumers, they might think that's a good thing because they can finally start getting some better returns on longer, 2, 3, 4 year CDs.
Mm-hmm. And I'm just thinking, and we can go back and check after the rates finally do actually move. But again, as we talked about earlier, they don't go in lockstep. It'll be really interesting to see if the Fed cuts rates. You'll probably still show a handful the next month that are going up. Would you agree
Right,
that's likely?
right.
It may not be a big number, but it's not going to be zero.
Right. And so often, as we've discussed, credit unions have the highest rates. They've got offer great rates to their members. It's part of their model, their service to community, their service to their members. And sometimes I think we might see institutions offering higher rates to compensate for lack of visibility.
Yeah,
I have
makes
to
sense.
offer these higher rates in order to get people to pay attention. So, the idea behind a digital marketplace may help address that with providing greater visibility to those good rates so you don't have to continue to raise rates in order to pull in the funding that you need.
Now you mentioned you do the marketing, you do the analytics, you do the account opening. Is that a la carte, or does that come as one package, or
No,
FI
that
can
is
do
all.
whichever of the three they want? Any
Yep.
combination?
That's a la carte. You mentioned the analytics piece. We call that our market intelligence tool, and that's where you can get access to the 30,000 plus rates from the 4,000 plus financial institutions. You can create your own competitive set in terms of looking at, what are people doing in my market? What are some of the national leaders doing? How does this play out over time? Rate movements, historical trends in rates, a whole bunch of analytical tools to help financial institutions better price their CDs in the market. That is a la carte tool that is provides a lot of value to financial institutions, especially those who are used to rate surveys and looking on the internet and finding out who's offering what in
I
my
was going to
market.
say you've got
Makes
out
that
there.
much easier.
And I'm just thinking from a consumer standpoint, you can go out and look, but it would take an awful lot of lifting for someone in an individual institution to splice and dice everything they got to look at. So you actually provide a deeper level of analytics on a
Correct.
fee basis to the institutions.
Right.
And I understand that and maybe not you personally, but CD of LA will be at Finovate again in a couple of
Yes.
months in 2025. Any interesting kind of new features or teasers you want to give us of what brings you to the stage this time around?
Sure. This will be the third year we've been at Finovate, and what we're excited about this year is sharing more about our market intelligence tool to help financial institutions price their CDs, as well as marketing services to help build trust and credibility for consumers who see your great rates on CD Valet, but want to know a little bit more about your institution before they choose to open a new account.
Makes sense. Well, I'll be there and I'll be very interested about hearing more about that. If people want to find out more, I think it's all there. You got kind of for consumers and for businesses at the top of the website, right? cdvalet.com.
Correct.
Great.
Great to talk with you, Glenn.
Mary Grace Frosky, Head of Marketing and Communications for CD Valet. Thanks so much and see you in September.
Great. Thank you.
So I'll be looking forward to seeing what else they've got to show at Finovate coming up in early September. I really like the idea of the fact that maybe some of that CD premium that they're paying in the market, the credit unions tend to pay more. We'd like to think it's because they're doing well by their members. Some of that may have to do also with the need to overcome their lack of visibility in the marketplace so they can reach the people who actually want those CDs. So a service like this may help address that lack of visibility. I really like the way the solution also allows, as she put it, a metered process. So if you're looking for a certain amount of new deposit inflow, it's a real-time situation where you can basically find out, when you've basically filled the bucket through this option. I also like the whole notion that, obviously not everybody can buy a CD from every credit union, that they appear to have kind of cracked that code. I'm thinking back to the old Googleplex, that Google banking app that was going to then magically route the people who wanted to do banking with Google. They were not going to be a bank. They were going to route it through to individual financial institutions. And when you particularly think about credit unions, not everybody could belong to everyone. Well, guess what? That Google thing kind of never showed up because they discovered it was a lot harder than they expected. Obviously, CDs are a very small piece of the puzzle, probably not as complicated, but interesting to see what CD Valet is doing with that. Also reminded me a little bit just about cool data in an area that's not usually thought of as quite that sizzling to the space. Our friends over at Bankography that did a lot of work around branches and understand the dynamics of those. And we talked to Steve Reeder about that, I think a few months ago. We'll post a link to that old episode as well. Because, me, I love data, and these companies have a lot of it. With that, another episode of the Big Cast. Again, my name is Glenn Sarvati. You can find my firm 154 Advisors in all the usual places. I'm on Blue Sky at 154 Advisors. Track me down on LinkedIn. Check me out at the Best Innovation Group website. You can drop a note there. As I said, you can find us on LinkedIn. You can find us at the website big-fintech.com. We've got new content here on the Bigcast pretty much every Tuesday. I know we will have new content again next Tuesday. You can find us wherever you pick up your podcasts. If you like us, subscribe, whatever there, you'll just get a reminder when the next one's available. I know a lot of folks have been doing that lately, and I certainly appreciate it. You can always find it directly at the Best Innovation Group website as well, the drop-down menu on media. You'll also find the blog option over there in the media tab, and you can check out that the post I did about real-time payments that I mentioned. But new content every Tuesday. If you don't get an automatic alert because you subscribe, check out the website big-fintech.com. Hope to see you back next week. As always, thanks for listening.
Check back each week for the latest from the Bigcast. Or better yet, we hope you'll consider subscribing for free via Spotify, Stitcher, Apple, or wherever you get your podcasts. If you have questions or comments, we'd love to hear from you. Tweet us at Big Fintech, email info@big-fintech.com, or visit us at big-fintech.com and click on the Media tab, where you can post a comment or check out our archive of hundreds of past episodes. See you next week.